Hello everyone, welcome back to Kumari's Commerce Hub. I hope all of you are doing well. So in today's lecture, we are going to study another important capital budgeting technique called accounting rate of return method, which is commonly known as ARR method. So in our previous lectures, we have learned about payback period method, net present value method, and IRR method. And each of these methods helps the manager decide whether a project should be accepted or rejected. And today we will learn a very different method. Unlike NPV and IRR method, which were based on cash inflows and time value of money, this method is not based on these things. Instead, it focus on accounting profit earned by the project. So by the end of this lecture, you will be able to understand what ARR is and why do we use this particular method. And also we will understand step by step process of solving the numericals, and we will also understand how to make a decision using this particular method. Okay, and after that we will discuss about the advantages and limitations like we discuss in all the methods that we have done in our previous lectures. Now let's begin with it. Now before starting ARR method, let's quickly revise what we already know. Okay, so we studied about payback period method, NPV method, and IRR method. Let's just recall them first because there's something which is different in this lecture. So we need to know what we have learned earlier so that we can understand what is different here. Now, payback period method tells us how many years it takes to recover the initial investment. And NPV method tells us how much value a project will get. And IRR method tells us the percentage return generated by a project. Now, all of these methods basically are based on the cash flows. So they focus on actual cash received from the project. Okay, but in accounting, we often prepare profit and loss accounts and calculate net profits after considering expenses like depreciation. So sometimes manager wants to evaluate a project using counting profit instead of cash flows. So this is where accounting rate of return method becomes useful. Now let's first understand the meaning of accounting rate of return. So you can write this definition in your notebook. Okay, so accounting rate of return is the percentage of average annual accounting profit earned on average investment made in the project. So now let's simplify this. Suppose a company invests money in a machinery. So after operating the machine for several years, the company earns some profit every year. Now instead of looking at the cash received, the company looks at the accounting profit reported in the books. Now then it calculates the average profit and compare it with the average investment. So this is the result that we are getting is called accounting rate of return. Okay, so in simple words, if I say basically ARR measures how much accounting profit a project earn compared to the average annual invested. Okay, now the student often asks like if we already have NPV method and IRR method, why do we need this particular method? The answer is very simple. Not many companies wants to evaluate project based on discounted cash flows. Some organizations also prefer a very simple method based on accounting information that is already available in the financial statements. So they use ARR method because it is easy to calculate, easy to understand, and very useful for the beginners. Plus, it also helps managers who only focus on accounting profitability. However, you have to remember that ARR is a traditional method and is generally considered less accurate than NPV and IRR method because it ignores the time value of money. Now let's understand the formula here. Okay. So let's understand each of these terms first. So firstly, what is average annual profit? So this is basically if profits are different each year, we first add them, and after that we divide them by the total number of years. Okay. And if I talk about the average investments, this represents the average amount of capital invested in a project during its life. Now, in most of the universities, this particular formula is used to calculate the average investments. We are going to follow this formula only. Okay. Initial investment plus salvage value upon two. Okay. So the initial investment is basically the amount spent at the beginning, as it says, initial investment. Okay. Next, if I talk about the salvage value, it is basically is the estimated value of a asset at the end of its useful life. Now, after adding these two values, we have to divide it by the two to get the average investment. Now, let's solve a numerical. You can write this numerical in your notebook. Okay. So here we have been given certain information, and we are going to use this information to solve the numerical. Okay. To find out the ARR. Now here initial investment is 1 lakh rupees and useful life is 5 years. Salvage value we have been given 20,000 and annual profits we have been given like 12,000, 15,000, 18,000, 20,000, 25,000. Now the first step that we are going to follow is to calculate the total profit because that is something we needed. Okay. So we are going to calculate the total profit. So total profit is basically 12,000 plus 15,000 plus 18,000 plus 20,000 plus 25,000. So basically, the total profit is 90,000. Now we need the average profit. Okay, as per the formula. So we are going to divide it by the total number of years. So total number of years we have here is 5 years, right? So we are going to divide it by 5. So we are left with 18,000. Okay. So our average annual profit is 18,000. Now we have to calculate the average investment. So as per the formula, we have to get two values like initial investment and the salvage value. So here initial investment is 1 lakh and salvage value is 20,000. So we are going to add them. Okay. So 1 lakh 20,000 divided by 2 is basically 60,000. So we have got the average investment as well. Now to find out the ARR, we have to use this particular formula, right? So let's substitute the values here only. Like we have the annual profit, average annual profit of 18,000, right? Okay. 18,000 and we had the average investment of 60,000. So let's calculate this one now. 18,000, 60,000. So you've got 30%. So our ARR is basically 30%. This means the project earns an average accounting return of 30% on average investment. Now regarding the decision, like how to make a decision whether to accept a project or not. So for that we use a decision rule here. Okay, so this is the decision rule where if ARR is greater than the required rate of return, then we accept the project, and if it is not, then we reject the project. For example, suppose a company expects a minimum return of 20% and our ARR is 30%. Okay, then we are going to accept the project. And if we reverse the situation, like the ARR is 20% and required rate of return was 30%, then we are going to reject the project. Obviously, because if it is not as per our requirements, then we reject the project. Okay. So the decision rule is straightforward. You have to compare it with, the ARR with the company's rate of return. Now let's discuss the advantages. So this is very simple. First advantage is that it is easy to calculate. So ARR method uses basic arithmetics, which is easy to calculate. So it is easy for the students and managers to understand. Second, it uses the accounting data, which means it is using the information which is already available in the financial statement. So you don't have to make extra effort. Next, it is easy to compare the projects. So project can be compared based on their percentage return. Okay. Next, it is useful for the performance evaluation. Basically, the managers can compare the profitability of different investment using this method. Now, let's talk about the limitations. Okay. So first of all, it ignores the time value of money. So this one is one of the biggest drawback of ARR method because it treats profit earned today and profit earned after several years are equal. Okay, so it is ignoring the time value of money. Next, it uses accounting profit instead of cash flows. Now, ARR is based on accounting profit, which can be affected by depreciation and accounting policies. Next limitation is it uses different accounting method which can affect ARR. For example, if two companies use different depreciation methods, so they may calculate different accounting profit for the same project, and which will automatically affect the ARR, because if accounting profit is affected, then ARR will also be affected. Okay. Next, it is less reliable than discounting methods. Like most of the method that we study, like NPV and IRR method, so they provide a more realistic evaluation because they consider the time value of money, whereas ARR method does not consider the time value of money, so it is less reliable. Okay, now let's discuss ARR and IRR method. Okay, so what is the difference basically? Here it will hardly take 2 minutes. And please note this one thing, like this questions can be asked in your exams, like tell the difference between ARR method and IRR method. Okay. So ARR method is basically based on accounting profit, whereas IRR method is based on cash flows. And ARR method, it ignores the time value of money, whereas IRR method consider the time value of money. ARR method is easy to calculate because of the calculation thing, whereas IRR method is a little complex. Okay. And if we talk about the what it uses, so it uses the average investment in, and IRR method uses discount rates. And ARR method is basically a traditional method, so it is a less reliable method basically. Okay, because it is using the accounting profit. And if I talk about the IRR method, it is basically a discounting uh, cash flow method, so it is more reliable. Now let's quickly revise what we have learned. So today we have covered the meaning of ARR and why it is used and the formula to calculate ARR. We have also done a complete numerical of it. And we have also seen the decision rule and advantages and limitations, also understood the difference between ARR and IRR. So this was all about accounting rate of return method. I hope the concept is clear now and you can solve ARR numericals confidently. And if you found the lecture helpful, please like the video, subscribe to the Kumari Commerce Hub and share it with your friends who are preparing for BCom, BBA, MBA or UGC NET or any other commerce examination. Thank you for watching. I'll see you in the next lecture.